Hello and welcome back to a weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. So this past week, we saw the worst week of the market so far this year. We were down 2.45% over the week. We are still up 1.45% year to date. But really, the main thing moving the market this week is we've consistently seen bond yields for treasuries going higher and higher on the longer duration. So instead of skipping around talking about other things, really, we just wanted to spend the whole time going into it. And I think the best way to really look at it is just to actually look at the data. So I'm going to pull up the data and we're going to look at exactly what I'm talking about. So right now, what we see is we've pulled up, and this goes for the whole year of 2021. When we look at it, we see the 2-year, focus on the 2-year, which is right here, and the 10-year, which is right here. So we're going to be focusing on those two columns. So the 2-year we see as of January, it was trading right around 11 basis points. And we see the 10-year trading under 100 basis points right at 93. Now let's scroll down. And what we see as we scroll down is we see, in January, the 2-year, again, sticking right around 11 basis points, but we're seeing a rise pretty dramatically in the 10-year. And as we keep going more and more, what do we see even through February? Still around 11 basis points. And now we've almost jumped 50% in the 10-year up until what we saw on Thursday. And that was where we saw the massive jump, and we got to over 150 basis points on the 10-year versus, again, just 17 basis points on the 2-year. And so what does that really mean? Let's talk about how does this pricing get worked in and why are we seeing such a big difference? So how does this pricing work? Every single day, the Treasury is printing different treasuries of different durations. And what happens is it's in the open market. So let's say Rich is an investor and they release their treasuries, and he's a 10-year treasury investor. And they release it at a yield, at a price of $1,000. Well, what if no one wants to buy it? No one wants to buy that treasury. So then what do? They start to lower the price. And as they lower the price, the bond yield starts to go up. And that's how we lock in these daily prices. So what happened? Basically, on the 25th, so on Thursday, they released a bunch of new bonds and no one was buying them at the release price. So the price kept going lower and lower and lower. What if it drops $25? What if it drops $50, $75? Then finally someone starts buying. And then what do we have? We have a massive increase in the yield. And then when bond prices increase in yield, stock prices really go down. And there's two numbers that we really always like to look at. And it's actually when the 10-year gets above 150 basis points or 1.5%, and the 7-year gets above 0.75%. Both of those happened on the 25th, which is a big reason why we saw that being the largest market sell-off of the week. So that's how we get to those sort of numbers. Rich, you were saying.
And what I was going to say is what you need to keep in mind is that every single day the government is selling bonds, and there are people buying it, whether it's pension plans, whether it's the Federal Reserve Bank, whether it's individuals, whether it's mutual funds or other governments. They're a constant buying and selling. And what you're seeing is there was a dramatic drop in demand for U.S. treasuries.
Yeah. And so now the big question is, all right, Knight, I understand why the 10-year has gone up, but why hasn't the 2-year gone up? And really the biggest answer for that is the Fed. So remember how I said it's basically an open market every day. They're coming, they have new bonds. Well, the Fed can buy bonds up to the 2-year mark. So when they release those new bonds, the Fed is buying them, but the Fed is not buying the longer duration bonds. So they can basically keep those interest rates or the bond yields relatively stable. And that's what we've seen over the 2-year. But since they're not buying any of the longer duration ones, they don't have that same control, which is why we have seen, again, big run up. So now that we've explained that, let's talk about some of the reasons why we might actually see that run up. From from our understanding, there's about 4 big reasons why we've seen this increase in yields. One, let's talk about stimulus. How do they fund stimulus? We have a $1.9 trillion package coming, and the way they fund it is, again, by printing more treasuries. So people are thinking today, well, I know that we're about to get this massive stimulus. Why do I want to buy treasuries today if I know we're going to be flooded with a lot more treasuries, and more supply means a drop in price? I can actually buy them lower and get a higher yield. So that might be one option. The second option is what I said about as interest rates rise, you start getting paid more money than you would receive. And it's a pretty risk-free way of getting money because it is backed in full credit by the US government. So as those yields rise, you're basically, would I rather have a risky, 5 to 10% in the stock market, or do I want a really, really risk-free 1.5% every year? So that's the second reason why we have seen people start to move into bonds. The third is this idea of inflation coming back in a real meaningful, big way in the second half of the year. What's the expectation there? On the longer duration, they think the Fed's going to have to raise interest rates. They can't keep it this low, even though the Fed has said they're going to keep it this low. If we see inflation go up dramatically, they're going to have to raise interest rates. So that's another reason why people could be, waiting to get into bonds and the price lowers. And then the fourth reason will be around. All right. And then the fourth reason, which is a little bit hard, is if people are expecting the economy to come back in a major way, and it means that growth is going to be there, people are going to be more willing to invest in the bonds because rates, they're expecting them to go up. So they're not going to invest right now. They're going to wait a little bit longer until rates are higher and then pile in then. So those are the 4 kind of big reasons that we've been looking at as to why we could see that massive jump. But I guess the real question is, we already saw the market sell off when rates go up that dramatically, again, cross those thresholds. We saw the market sell off. Have we seen a peak in rates going at this height? Are they going to start to fall down? Or what's going to happen next is kind of some of the thoughts that we're looking into. So Rich, what are your thoughts?
Well, currently, I think that we're on a trajectory where rates are going to go up. There is the belief that as the vaccines come more and more into people getting inoculated, that the economy is going to open up more and more. We're going to see a very big boom, and that's going to help propel the economy to a greater growth. And as a result, we're going to see interest rates move up.
Yeah, so I think in the long term, over the long term, we will see interest rates rise. For the short term, I kind of have a different view from Rich. I think we probably have seen a short-term peak. I think we did move maybe a little bit too fast. We did see a big market sell off from it. And I think we could see rates start to pull back on the longer part of the yield curve a little bit more. So that 10-year going down a little bit, and the 2 years, again, probably still staying relatively stable. So we'll see. Again, if that happens, then the market probably will be able, the stock market will be able to come back in a meaningful way, in the few weeks. But if we do continue to see the long-term end of the yield curve continue to rise, that gap between the 2 and the 10-year lengthen, we might continue to see this market get spooked and sell off more and more.
Yes. Now, that having been said, we've been working on the portfolios to take into account rising interest rates. So your portfolios are designed to withstand this growth in interest rates, rise in interest rates, I should say.
Yeah, in many ways, rising interest rates, as interest rates are rising, it sucks for everyone. Why? Because the current bonds that you hold become less valuable. Because why do I want the current bonds that are paying when I could get new bonds that are paying a much higher coupon? So the current bonds that you hold become less valuable. And as interest rates rise, people leave the stock market. So rising interest rate environment, no one really enjoys it, but the goal for us is, again, to get you as short duration currently on your fixed income. And then as rates do become higher, you pile into them at that point. So we have been analyzing your fixed income portion. We're analyzing, again, the equity portion. We're on top of these. But really, for this past week, that is why we saw this massive move in the market. So as always, thank you. We're here to support you. Your money's here to support you. If you have any questions, please feel free to ask us. And if you're seeing this video on YouTube, please give it a like, hit us a subscribe. We always appreciate it. It helps out the channel, it helps us grow. And that's our goal, to keep giving this to as many people as possible. This is our 1-year anniversary. This is our 52nd episode. So we've now done 1 full year of this, and we look forward to the next year. All right. Thank you. Bye.